In this video, I'm going to be showing you the single most powerful indicator you can use in your trading so you get more results, more money, and more wins. In fact, I use the same indicator to make a couple of withdrawals like this, and this. So stick to the end of the video because I'm going to be revealing the name of the indicator and how you can apply it to work for you. So let's get into the video. In order to know how to trade with the indicator, I think it's very important for you to know the components that make up the indicator. So when I'm explaining the terms, you guys can understand. So let me just show you what the indicator does and how it works. So the indicator is a combination of different indicators all together into one package. So we have the volatility bands, we have the RSI, we have a static baseline, a dynamic baseline, and a signal line. Those are the 1, 2, 3, 4, 5, the 5 components that make up this indicator. So the volatility bands are the blue lines. They show the volatility of the market. So when volatility enters the market, the blue lines will show you and indicate that there's more volatility than before. So here's an example. Here we see the volatility bands are close to each other. That shows that there's little to no volatility in the market. And the moment the volatility comes, you see that the bands expand, they separate, they spread apart. And then when the volatility is gone, they come back together like this. So they show you when the market is volatile and when it is not, so you can know the best times to trade and when not to trade, when to take a pause and take a rest. Now the RSI, this is just the basic RSI, just put in here. It's the green, this is the green line, the green moving average, or whatever you want to call it, the green line. It's going to be used for the trade entries. It's the way it works is it prints the closes of the candle. So when the candle closes, it prints. Each candle that closes, it prints. So we move over to the static baseline. The static baseline is basically the middle of the indicator, the middle, the 50 level of the indicator. And then the dynamic baseline is the yellow line. This one, it is actually the baseline too, but it moves. That's the unique thing about this indicator, is that the baseline moves. Other indicators are just static; they have only the static, but this indicator has the baseline moving. It's like a moving average. It moves like this. So, and the dynamic baseline helps to identify the trend, so we can know if the market is in an uptrend or downtrend. When it's pointing down like this, that's a downtrend, and when it's pointing up like this, that's an uptrend, because we always want to be going in line with the trend. Don't want to go against the trend. And then the last one we have is the red signal line. The red signal line is basically the RSI, but on the 1 hour chart. So this red line you see here on the 15-minute chart is basically the RSI on the 1 hour chart. It helps us to confirm the trade or the trade signal on the higher time frame while looking at the 15-minute time frame. So when the RSI crosses the signal line, that tells us that the 1 hour chart has given us a sell signal or a buy signal, whatever signal it is. So in this scenario, it's a sell, and then let's say a buy signal here. It's crossing it to the upside. That tells us that yes, the 1 hour chart has confirmed a buy and everything is good to go. So those are the components of the indicator, and let's head over to the source of the video, how to use the indicator to actually trade. So let's get to it. Here's how the indicator works. There are 3 ways to trade this indicator. The first way is called the shark fin setup. The second one is the baseline cross, and then the third one is trading divergences. So I'm going to explain the first one, the shark fin, firstly, then we move on. So here's how the shark fin works. The name shark fin is gotten from when the indicator, the RSI, goes outside the volatility bands and enters back inside the volatility bands, and that gives like a shark fin type image. Let me show you an example. So imagine the volatility band is like water, right? And then the shark is inside the water and gives and the fin comes out like this. You know how in water the fin comes out like this? Shark fin, yeah. So that's where the shark fin comes from. That's where the name comes from. So the trade is basically when the RSI goes outside the volatility band and enters back right into the volatility band and crosses the signal line. It has to cross the signal line. So when it crosses the signal line, That's the trade confirmation. And then in this scenario, you can enter on a sell here, you can enter on a buy here. That's the shark fin. So let me show you examples of how that works so you guys can know and see it. So let's get to it. Now, here is a beautiful example of the shark fin, right? Here's a trade. Here it gave us two, okay, no, just one setup. One setup. That's here. The entry on this would be here. Why would I enter here? Because we see on the indicator the shark fin, the RSI goes outside the band and enters back into the band. It goes out, enters back, crosses the signal line, and then we enter on a buy. Put your stop loss below the low, the previous low, and then you can go for like a 1 to 2 risk to reward on this trade. Let me look for another example. Okay, yeah, so here's another example of the shark fin. We can see the RSI goes out, enters back in, and crosses over the signal line, and we enter on a sell position right here. Get on a sell, stop us above the highs. Let's see if it gives us a 1 to 2. Yeah, gives us a 1 to 2 risk to reward on that trade. Let's look for another example. All right, so here's a very beautiful example of the shark fin. You can see the shark fin right here. As the RSI goes outside the band, enters back inside, crosses the signal line, and then the entry, I believe, is gonna be right here. Just stop loss above the highs and go for like a 1 to 2. If you held this for how long is that? If you held this for like 8 hours. Ooh, that's a long time. Well, if you held it for 8 hours, you have like a 1 to 6 risk to reward. But if you're just day trading, you can just go for like 1 to 2 or 1 to 3 or 1 to 4, depending on how the setup is and if you're going in line with the trend. So let's head on to the second uh the second type of setup, which is the baseline cross. So let's get to it. So yeah, the baseline cross. This is basically when the RSI crosses over the baseline, which is this yellow moving average. When it crosses over this yellow moving average, the baseline, not the 50, the dynamic baseline, this yellow one. So when the RSI crosses over there, you take a trade, either buy or sell. So here are just examples of that. As the RSI crosses over the baseline, you take a sell there. Here you take a buy. You take a buy here. And that's how it works. It's as simple as that. Let me show you guys examples on what I'm talking about. So right off the bat, we have an example live. You can see it's a live market. So we have a trade here. You can see the RSI crosses the dynamic baseline twice. So it gave us two entries. The first one was here, which would have hit your stop loss if you put it below the low. And then the second entry was here on this candle. And you can see this one worked, which was also like a combination of the shark fin and the baseline cross, which is more powerful. You can see this one didn't have like a shark fin, but this one had the shark fin and the baseline cross, and that worked out well. When you're taking these trades, you don't really need the shark fin. For the baseline cross, you don't really need the shark fin, but it's more powerful if you have the two on it. So let me look for another example. Yeah, so here's another example. Yeah. So we see the cross happened here, and that would be on this candle. You can put your stop loss. You don't need to put the stop loss all the way over to the low. You can just put it below the candle, and you can take it for like a 1 to 2, 1 to 2.5, whatever you want. And that worked out. Let's look for another example. Here's another example. Here, yeah, we took the cells here. This worked out perfectly. Yeah, this worked out perfectly. I can see, I'll get to this soon. I can see like the combination of the three setups right in this area here. So that's how the baseline cross works. It's actually more powerful than than the, what's it called, the shark fin. It works more than the shark fin. But let me see. Okay, yeah, no, not there. I think kind of hit it. But the entries are a little bit later than the shark fin. The shark fin is kind of like an earlier entry, but the baseline bounce is more like a, sorry, the baseline cross is more like a more confirmed entry. It's later, but it's stronger and more confirmed. So let's go over to the third one, which is divergence. Yeah, divergence. Now, divergence isn't really hard to understand. I think most people are familiar with this. So here's how divergence works. When you see price making higher highs or lower lows, right? These are higher highs. For example, in an uptrend example, we have higher highs, but on the indicator, the RSI is giving you uh lower highs. So price is giving you higher highs. The RSI is giving you lower highs. So that tells you that the market is about to reverse soon and become a downtrend. And same example goes for the downtrend. If you're getting lower lows, but the indicator is giving you higher lows, then that's the divergence, and you're expecting a sell or a buy. Yeah. So when you get an uptrend like this, the indicator can either give you equal highs or lower highs. Okay, no, that's kind of equal. Then lower highs like this. So this is divergence, right? When the price is giving you one thing and then the indicator is giving you another thing. So let me show you examples of that. Let me see if I can find an example. Yeah. So here's an example. Here, right? So we see here's a high, lower high, lower high, lower high, right? And lower lows, lower lows, lower lows, lower lows, right? The indicator gave lower lows too, but at a point it gave a higher low here, while price gave a lower low here. So that is your divergence. You draw a line like this. Let me clear this out. So you draw a line like this to signify the divergence. And then you look for a candlestick confirmation, like a hammer. And then you get this on, put your stop loss below the low and take the trade. So let's look for another example. Let me see. Yeah. So if you draw a line like this and draw a line like this at the high, here's the high, here's the high. You can see price made a higher high right here, right? But on the indicator on the RSI, it gave equal highs. You have equal highs on the indicator, while on the charts on the price we have higher highs. So that's your divergence right there. And then you look for your candlestick pattern. You have a hammer here, just like we had here, and then you take the trade on this hammer and take it down 1 to 2, 1 to 3, whatever you want. Let's look for another example. Okay, we got another example here. Yeah, we see lower lows, right? Lower lows, lower lows. But at this point, we have a lower low here and a lower low here. On the indicator, we have a lower low here and a higher low here. That's your divergence. You draw your line for the divergence, look for your candlestick pattern, and we have railroad tracks here. Take it up 1 to 2, and yep. And you can also see an added confirmation is the head and shoulders pattern we have here. That's an added confirmation. So that's basically how the divergence works. Yeah, it's basically the strongest confirmation of the three. The divergence, you can use the divergence as an added confirmation to the two. So when you get a shark fin and you get a divergence, that's a plus. If you get a baseline cross and you get a divergence on that's a plus. If you get the three confirmations altogether, that's even the best. Like that's the best. So this example I gave here, what can we see? We see shark fin, right? We see divergence, and we see a baseline cross here. So if you got in a trade here, you can basically get in on another trade on the baseline cross, which is here, and then take these two, so they take profit. So now you have two trades. That's 1 to 4, or 2 to 4, basically. So if you have the three confirmations altogether, that's even more powerful than just having one or two. And that's how the indicator works. So now the name of the indicator is called the Traders Dynamic Index. The Traders Dynamic Index, the TDI in short. Traders Dynamic Index, or TDI short. Yeah, it's called the TDI. And if you want to add it, just go to indicators and search for TDI. You see the one by gold mines, by this guy here. Is it Donovan? Yeah, TDI by Donovan. And just click on it, and you'll have the indicator. You can go to the settings and change the colors however you like. These are the colors I prefer for the dark theme. So that's the name of the indicator, and that's how to use the indicator. It's like the best indicator you can use.